Hello traders, how are you? This is Wanjiru Gishangi of Forex Experts Online Academy. How have you been? I hope you've been well and I hope you've had time to watch the other videos. Remember, you can always request your video either as a comment, you leave a comment on a video, or you can go to Facebook and find my Forex Experts Online Academy page. There you can send me a message. If you're not on Facebook, you can go to LinkedIn, same name, Forex Experts Online Academy. Send me a message. Let me know the videos that you want me to create for you that are going to add value in your trading. Also, if you do not have a reliable broker, I have a broker recommendation. So you can just click on this link here and you get a good broker who has good spreads and of course zero market manipulation. Therefore, this is my broker link, affiliate link, and I would really appreciate if you can use that. So today's video is on point of interest, or what we call the key areas in the market. So there are so many key areas depending with your school of thought. Now, for different traders, they'll have different points of interest depending, of course, with the strategy. So I'm just going to talk about a few. I know there are so many, but I'm going to talk about the most popular here. So when we talk about key areas or points of interest, what are we talking about? We're referring to areas in the market where different schools of traders are watching out for entries. It doesn't matter what type of trader you are, but when we're talking about a point of interest, basically we are watching for entry. So if you're a block trader, you're still waiting maybe for a retest of your block. If you're a trend line trader, you're waiting for the touch of the trend line or rejection of the trend line. If you're a moving average trader, if you're a candlestick pattern trader, so we're waiting for entries. Basically, a point of interest is where different traders are watching for entries. Now, when we saw many and we're watching out on a certain level or a certain key area, now it increases the chances of possible price reaction. Now, this is the psychological part of Forex trading, whereby even our sentiments, I think in previous videos, I talked about different ways to analyze the market, and one of them was the sentimental analysis. Now, our sentiments, our fear, our greed, our expectation, our fear of missing out, they also have an effect in the market, and that's why we're saying they increase. How do our feelings or our emotions affect the market? They increase the chance of possible price action. Of course, the market will move whether we have emotions or not. But the more we are, the more emotions or the more uh, power or the more chances of a reaction due to our emotions depends with how much the strength of that particular key level. So what are some of these key levels we're talking about? One, this will be the previous day high or previous day low. Now you can just Google for search. There are indicators that will show search. So you can just go to Google and maybe search for previous day high, previous day low. Alternatively, you can just mark it manually. So you just go to your chart. I already taught you how to divide a naked chart to show the days. You just click Control Y on your computer or on your keyboard if you're using your laptop or desktop. But if you're using your phone, the days are already marked for you because there will be that black dotted line showing the end of the day and the beginning of the day. So once you click on Control Y, this is for the computer users. Now you can have Monday, Tuesday, Wednesday, the days of the week. Then for the high of the day, the previous day, you just go to previous. Let's say today is Tuesday. Tomorrow is Wednesday. So at the end of today, if the market got to this area, then consolidated, then there was the beginning of Wednesday that happens there. Now my previous day high, you can just draw your trend line or just a straight line from this, and this will be previous day high or what we call yesterday's high. And if now the Tuesday low was there, you can just draw a line. It's so easy. You just draw that and that will be your yesterday's low. So now when you're trading on Wednesday, you'll be paying attention to the yesterday's high and yesterday's low. What type of attention are we talking about? We're talking about how the market is reacting, how the market is reacting on those 2 points. Now, this is for intraday traders, the people who want to trade that specific day. You want to know if the market rejects or stop hands your yesterday's low, then you know that the market will be pushing up for the day. So if this market shows up here and throws some tails, or there's some reversal candlestick pattern here, you know that you'll be looking for a buy. If the market does the same thing, it stops hands to yesterday's low or has a reversal pattern at the top here, now you know you'll be looking for a sell. So that is how to use the previous day high or low. There's a video on the page that I've talked about a very, very stable strategy. We call it the stop hand strategy. It pays more attention, or it's basically on that previous day high and low type of trading strategy. It's a very, very stable strategy if you can master it. The only downside to that is because it works on a trending market. So if you encounter a range for quite a while, then you'll not be having so many trades. Of course, there'll be trades because stop hands will still work, but there will not be as many as if you're having the same on a trending market. Then the next is the previous week low and previous week high, which is LWH and LWY on your indicators. Again, you can go to Google and get these indicators, or you can do them manually. So at the end of the week, so you can have maybe first week, then we have maybe the second week. So if the first week got to that high, then there was consolidation to the other week. You just mark a line to the top there. That will be your last week high. And on the bottom side again, you mark your straight line. That will be your last week low. How do you use these two key levels? Of course, the same way how the market rejects or interacts with those points. If it's at the low, you want to see rejection and reversal candlestick pattern if you're going to push it to the high. Now, again, if the market is interacting with your last week high and it gives you a stop hand, you'll be looking for the market or trades with short to the downside. You can use these two while trading the savior strategy, or the strategy that I discussed as the stop hand. This is the strategy that I'm talking about. This strategy. So you can watch this video on the liquidity grab strategy, and you can use these two key levels to work on that strategy. So moving on, we have the swing highs and swing lows. Now for swing highs and swing lows, this is basically market structure. I think I've sang the song on market structure enough times that any trader who wants to be a successful trader, this is the video. This is the video. I think this is the millionth time that I'm saying this. This is the video that you need to master in, out, inside, out, market structure. Market structure is king when it comes to trading. And of course, you can see it is also giving us a key level where we talk about the swing highs and swing lows. Now, basically on market structure, I think I've mentioned it so many times. If you're not buying, you'll be creating higher highs and higher lows. So if this is a higher high, then this will be a higher low. Details why it's called that, of course, you can watch the market structure video. Then we have this as a higher high, and this will be a higher low. Same as this. So this is what we call the swing highs and swing lows. Market structure. Note that market structure can be on any time frame, but the ones that hold a lot of weight, or the ones that really are amazing, or they'll give you awesome high probability trades, are the ones that are on higher time frame. I guess everybody in here knows what higher time frame means. Those higher time frames, 4 hour, daily, weekly, monthly, okay, higher time frame. They give you the high volume or the high volume moves or the high impassive or sponsored moves. Then the other one will be on the selling side. If you're on the selling side, now you'll be creating lower lows and higher and lower highs. So these will be your lower lows. Is basically market structure. Watch the market structure video for more details. So this will be a high, but it's a lower high. So these points are also key points. Why are they key points and how can you use them? You use them when you want to get into a trade. You're going to use these points, the swing highs and lows, for entry. Let's say you have this lower high and the market wants to maybe to retest. So if there's a retest to that area and you know that this is a lower high, then which is the probable move that you need to take? Of course, you can only sell. So it's going to help you, one, for entries and of course to avoid bad trades. Because if this lower high has not been broken, that means you can never ever get a buy trade. For it to be a confirmed buy trade, you have to wait for the break of this. The same, if you have this lower high here, you can never take a sell trade until this is broken. That is the rule. Okay, even if you take this sell counter trade to this area, you cannot continue, you cannot call it a reversal until this area is broken. You can only wait for retest back, then you continue buying. For example, what is happening on USD today? And when that happens now, this also changes to be something that you may call a flip zone or something. Okay. Then we have support and resistance area. Support and resistance area. Of course, I'm going to show you all these points on a chart. But support and resistance area, these are where the market has had some psychological reaction. So the support will be at the bottom side. So the market has been tapping that floor, pushing up, tapping it again, pushing. Remember, it doesn't have to be really, it's not a straight line. I already mentioned it on the support and resistance video. The support and resistance is not a straight line. It's actually a line of best fit, or it's a zone. And then at the top there, you'll be having a ceiling. So you have a ceiling and a floor. So the market will be tapping it, then reacting down, tapping it or stop hunting it, then tapping down. So these will be the support and this will be the resistance. So if you don't know how to draw your support and resistance uh, zones, well, of course, I have a video. I think 2 videos back, you're going to uh, learn how to do that the correct way. Then we have the supply and demand zones. Now, there's usually a very thin line between support and resistance and the supply and zone and demand zone. Maybe in a future video, I'm going to give 2 differences or how to tell or how to differentiate. But basically, they work on they work in the same manner. So support, the supply zone will be where there is that huge movement of sellers or where there is that huge drop. So the supply zone will be at the top there. Remember, it's a zone, not a line. So when the market gets to that, there will be a reaction, a very violent reaction to the bottom side. While the demand zone will be at the bottom, it's a buying zone. So when the market gets in there, there is another violent move to the top side. So this becomes the supply zone, while this becomes a demand. Of course, there are rules of supply and demand. If you want to know more about supply and demand, there is ebook 4. The price action book talks mainly on how to trade supply and demand zone. Therefore, you can get a copy. You can get a copy of this book. Remember, you can always go to the Forex Exploits page on Facebook and ask for a copy. So this is the book that I'm talking about. This book here, this 4th book, the price action book. This is what gives you the supply and demand in details. You know how to trade that. Moving on, we have what we call the trend line touches. So now with the trend line touches, say you draw a trend line, if on a buying cycle, you want to have your trend line on the bottom side, My drawing. My drawing skills are not improving. So we have this trend line, a buying trend line because or an upward trend. You have the trend line to the top side because you're pushing up. So the touches, when the market touches your trend line and reacts of it, comes, touches it and reacts of it. Now these points here, they become key areas. The touches, the trend line touches, they also become points of interest. Why are these points of interest? Because at some point, or if you go to a lower time frame, now there will be change of market structure with every touch. That is a touch on the higher time frame. Be very keen on this point. If you're making notes, write this. On the higher time frame, each touch on your trend line should give you change of character or change of market structure on the lower time frame. That is what makes it a point of interest. Then, of course, on the setting side, if you're on the setting side, you have this trend line to be sorry. If you're on the selling side, of course, you have this trend line. Now it's pushing down. Let me change the color. So the trend line now will be facing the other side. Now any touch to that trend line reacts down. Any touch reacts down. So these touches on the sell side also become key areas. Very, very important. Then we have the moving average rejections. Now remember, the moving average is also a trend line. It's only that it's dynamic, it's moving. So you can use it, you can call it dynamic support and resistance or dynamic trend line. Okay, a moving average is basically or works the same as a trend line. It's only that now it's not a straight line, it's moving. And just to remind you, there are different types of trend lines. Therefore, you can watch the other video on trend line so that you know the 3 types of trend lines and how to use them. Don't just draw a straight line and think that it's sufficient. You need to know if it's an aggressive, passive, or counter trend line, which you can, of course, watch on the trend line video. Then we have the moving average rejection. So let's say we have this moving average here. Let's do a green one. So we have this buying or moving average. Then the market interacts with it, rejects of it, goes, touches it, moves up. So these touches or rejections where it's not breaking it. And sometimes this is textbook, meaning it's super perfect. Sometimes in the market, it may look like this. You have this, and then the market is touching. It's actually, it breaks but gives you a fake breakout, then goes back, touches again. These areas here. I'm yet to create a video on how to differentiate or to tell a fake breakout. I just want first to clear all the basic parts, and then I will do the video on I'll do the video on the fake breakout or how to identify the breakout, the fake breakout. Then we have the axis points. Now, what are axis points? What are axis points? Axis points are basically the most confluent, the most confirmed. This is where now two key levels interact or 2 key levels meet. For example, an axis point can be a point where a trend line is interacting with either a supply or demand zone. Or it can be where a moving average rejection is interacting with maybe a support and resistance or a key level like a swing high or a swing low. So an axis point is where 2 or even 3 key levels are touching or intertwining. So an axis point is where 2 or 3 key points or trend line, moving average, support and resistance, supply and demand, whichever, that they are moving together. So it has extra confluence. Remember, if you want to take the 99.9% probability trade an axis point. For example, you open your USD CHF chart right now. The market is at an axis point. I'll show that when we get to the chart. And the last and not least, we'll be talking about the strong block areas. Now, if you've watched the block series is the video where I told you what are blocks, which blocks work, how to use blocks for entry. So it has a part 1, part 2, and part 3. I'm going to show that on the video. So if you've gone through that, that would be awesome, because a strong block, I'm not talking about all blocks, I'm talking about a strong block. A strong block has an 80% or 88% chance of being retested, and therefore it gives us a very awesome key or point of interest. So these are the different types of key points or points of interest that we will be dealing with today. So now let's get to the chart. But before we get to the chart, I want to mention about the supply and demand videos. So make sure that you watch these videos in this order. 1, for the supply and demand, you can watch this video here. Okay, for the trend line, this is where you learn about the different types of trend line. For the previous day high, last week high, stop hunt, liquidity grab strategy, this is the third video to watch. And of course, for the different types of blocks, you need to watch the 3 parts. So we have blocks that hold, we have the refinement, how to divide those blocks for perfect entries, and of course, we have entry setups. So if you're a block trader or you want to learn about the types of blocks, this is part 1, part 2, part 3. But remember, the block should be the fourth video that you watch. So watch them in this manner. Market analysis, 1. Demand and supply, 2. Trend line, 3. And 4 blocks. Okay, in that manner, now you're going to really understand the points that we have discussed here. Everything in those 4 blocks, apart from the axis points that, of course, I'm going to. Don't forget, I almost forgot, there is the 5th one, which is the support and resistance. These the different types of support and resistance. So those 5 videos, again, 1, market structure, 2, it's market structure, supply and demand, trend line, blocks, then support and resistance. 5 videos. So let's get to the chart to find the different types of key point. So if you're using a naked chart, these are the steps. 1, click on Control Y to divide your chart to days. And then from there, you can manually mark. So if this is today, this was yesterday. So you can pick the highest point there. Let me change my color to a visible color. So that is my high. Or you can just get, you can either draw it as a trend line, or you can do a horizontal line. So, and that was the low. So basically, this is my yesterday's low. This is my yesterday's high. Then if it's last week, the same, you can go to a higher time frame, which is 4 hours. So with the 4 hour, it gives you the whole week. So you can have this as last week high. This is last week high. Change the color. So we have last week high there. And of course, we go to the lowest part. It's still here. So we have last week low. So that's how to draw them manually. But of course, if you go to your Google and you search for the indicators, you can get them and just apply them. Okay, so for example, I already have my days there. We have the last week low. So it will be marked last week low, last week high. There will be YH showing yesterday's high, and YL showing yesterday's or previous day low. So again, that's how to mark them. How you use them is how the market is interacting. See, this was a low, but it got broken to the downside. They are very huge momentum candlesticks. So this break basically says that we have no chance of the market going higher. Therefore, you wait for the close of this momentum candle and you can be looking for sell. Same thing here, you find the candlestick language around there and it confirms that we are selling. Same thing that happened today. There was a tap of last week low, but the candlestick pattern just said no, we just rejecting that area. So how you use the highs and lows for entry, of course, I'm going to mention it on another video. But this one, I just want to highlight those points. Number two, we have the market structure. We talked about market structure or the swing highs. So after you, from when you're marking your market structure, just to mention, you need to identify your highest or lowest point. So it can either be a peak high or a peak low. How you identify a peak high or peak low, it depends with where the market is coming from. If the market is coming from a high, of course, you want to pick a peak high. And if it's coming from a low, it's going to be a peak low. In this case, the market has been coming from a high. So we have our highest point, and the next high did not break, or it was lower, it did not break our previous high. This is what we call failed market structure, or SMS, okay, SMS, okay, something like that. Or you can just call it lower high. So you have a high, lower high. After you have a lower high, what do you want to see next? You want to see break of market structure. That low point, that before you can now say that the structure or the market is actually changing. And now we see this momentum kind of giving us our low. Don't chase the market. If you want to get entries, of course, don't chase it. After every break, you expect a retest. So once this happens, just sit on your hands, wait for a retest. It's going to give you a better entry. And if you're a swing trader, this is where you get your trades and you forget about it until there will be a change of direction. And of course, if you miss this, what do you look for? You wait for those lower highs. If this is a downtrend, this has been a clear downtrend. So you're going to be adding positions or getting more entries after every break and retest, giving you a lower high. The third one is now the support and resistance. Of course, you want to mark your ceilings and your floors. And remember, support and resistance is a zone, not a line. You can watch the support and resistance video to know how to draw them. You want to see how the market is interacting with your zones or your support and resistance zones so that you know when it's broken. The other one is support and supply and demand. So those sell points at the top will be your sell or your supply. When it's turned or when it's broken by a green candlestick. Now these are the rules. I've already mentioned them on ebook 4, and I've already mentioned them on the supply and demand video, where a supply will turn demand if it's broken by a green candlestick to the top side, while a demand will turn supply if it's broken to the bottom side by a red candlestick. So that's an example. Then we have what we call the trend line touches. Remember the different types of trend lines that we have. Now you want to touch the first high and of course the second swing high. That would be the passive, okay, the passive trend line. Now every touch of that becomes a key area. But now not all the times that the market will get to your passive trend line. So you need a different type of trend line, or what we call a more aggressive trend line. It's closer. It's closer. Sometimes the market will not get to this trend line at the top. So you want the aggressive trend line that touches those highs. For me, I usually prefer if it touches those tweets. It's very perfect if it does that. But there are people who like the body. So you can also do the body to body touches. And of course, every touch of that trend line becomes a key area. The moving average, now for moving average, now this depends with your speed of entry. For me, on this video, I'm using the 50 moving average. You can use the 100, you can use the 200, you can use the 20. It all depends. For me, when it comes to divergence trading, or when it comes to points of interest, I prefer the 100 SMA. But in this video, I realized that this is giving more points. So each touch, each interaction, remember, touches of your moving average does not always mean reversal. No, what you need to pay attention to is the candlestick language. And I have a video on the candlestick patterns or the candlestick formations at different key levels. So watch that video also. then check how your moving average of choice is working. Remember, all moving averages work the same way. It's only that others will have more touches if they are slower, and you know, others will not have so many touches. Then we have the axis point. Remember, I already mentioned what an axis is where two levels come together, or these extra confirmations. So here you get the first passive trend line touching the moving average. So this becomes a key level. Then we have the demand zone turn supply, the demand turn supply zone. Then the retest is just touching on that trend line. So it also becomes another axis point. So axis points give you extra or higher probability every time you want to get into a trade. So if you want to have those zero drawdown kinds of trades, now you can be an axis point trader only, where you don't care about any other key point. You only look for those axis points. That gives you awesome probability on your trade. Therefore, you can flex your muscles when it comes to your lot sizes. You can do the best that your account can do. And then we have the strong blocks. This is for block traders. We have different types of blocks, and one of those types of blocks is what we call the strong block. You can also call it the engulfing candle block. Now, this is the strongest. That's why it's called strong block. Every time you get it on the higher time frame, there is 98.999 chances that there will be an awesome retest. And an example is this. You have this beautiful engulf block here. And what happens, there was that event or economic event candle or move that happened there. We also have others where there is no economic uh, event happening, but still you see the same reaction. When you have an engulfing candle on a higher time frame, it's always important that you mark it out, because chances are it's going to give you an awesome trade. So those are the key areas that I mentioned on this video, and I hope you make notes. Not only making notes, you're also going to go to your charts, try looking for those areas, check how the market is reacting on those to give you awesome entries. Remember, do not trade against these key areas, otherwise you're going to mess out your account. I am Wanjiro Gishangi. Do not forget, communicate, talk, send me comments, send me a video request, let me know, interact with me on my Facebook page. This is where I do my live sessions. I usually do live sessions depending with my availability. So if you want to interact with me on a live session, you can follow me on the Forex Exploits Online Academy on Facebook. I always alert when I want to do a live session. You can get either of my books, depending with your level of skill. You can get a book of your choice, depending the type of trader that you are. You can send me a WhatsApp using this number. Don't call, please. Just send me a WhatsApp. You can also comment. You can also join my group on Facebook. It's called Forex Exploits Group. So you can also join this group here. Same information as the one that's on the page. But I would really appreciate if you can subscribe to my channel. Hit the notification bell so that every time I share a new video, you'll be notified. So make sure that you click the notification bell, subscribe, and share these videos, share these channel links to all your trading communities, and I'll really be glad. I'm happy for your feedback. Thank you so much. Until the next video, I'm Manjiri Bishangi. Bye bye.